David Nicholas with us this morning. The market doesn't seem to care about a possible Harris administration. We seem to be still in a melt-up mode, are we?
Well, Stuart, I think we are, but I don't think the market actually believes that Kamala Harris will win the presidency in November because, again, we're talking about price controls, right? We're talking about the federal government dictating to local grocery stores what they can charge their customers. We've seen this with abject failure throughout human history, from the Romans to the Egyptians to the Babylonians. We saw this after the French Revolution. It led to grain shortages. After World War II, led to apartment shortages. So I think we need more supply. We need less litigators. We need less lawyers. We need more job creators. And last night, Stuart, you were there. Correct me if I'm wrong, but what I heard was attacking businesses, attacking the wealthy that create those jobs that we so desperately need. So no, Stuart, the market doesn't believe it yet, but if that ever changes, I think the market is in for a rude awakening.
What do you make of that $25,000 for home buyers that is a proposal by Harris? What would that do to the housing market?
Stuart, this is another manipulation of the free market. It's the government trying to create demand that doesn't otherwise exist. So what happens is, this is the unintended consequences, Stuart, is you have home builders now will shift to only build homes that lower income or first-time homeowners can buy. So what you get is you get a shift from what the market wants, and then that credit, the $25,000 credit, it will run out at some point. And when it does, we saw this in 2010, home prices will drop afterwards. So it's a manipulation. It won't work, but it leads to home builders being less profitable in the long run, Stuart.
Why do you like gold and treasuries?
Yes, Stuart, I think with the geopolitical risk that we have, and also the odds are high that the Feds will lower rate. Many investors look at gold as a hedge against inflation. Gold is actually a hedge against a weak dollar. And so as the dollar goes down, that bodes well for gold. Just a really simple way for our viewers, Stuart, GDX is the gold miners. I think gold miners will make more money as gold prices go up.
Would you have like half of your portfolio in gold and treasuries and half in stocks? Is that how you do it?
You know, Stuart, that's not a bad allocation. We like that for clients, especially if you're approaching retirement or in retirement. Look, I want to be very clear to our viewers, Stuart. I think you need a hedge going into the November elections. I think 50% of your portfolio in gold and treasuries, you still want to own stocks, but the volatility that we could see, the markets have done well. I don't want to rain on the parade, but I think a lot can change very quickly, which is a hedge like gold and treasuries makes a lot of sense, Stuart.
Okay. You make sense to me, too. Thanks very much for joining us, David.